for his extreme trends
Sure.
strategy.
We'll make it so.
Okay.
We'll drive on. Evening, guys. Ken at Tortoise Capital with the team. Monday night coaching, December 15th, 2025. The Ides of December. All good here. And the Pen 3.0 continues to amaze. I mean, holy smokes. Yeah, I get guys all over the college using it, general officers using it, the good people of our community using it. It's the deal. It's working.
Yes.
Uh, Ashay, how are you doing? Just a quick check in.
Uh, I'm doing all right. I'm quite, I think, exhausted, managing two jobs, but things are good, all things considered.
Yeah, I saw you used the Pen 3 for your
Yeah. Yep.
mortgage stuff.
Yep. For a mortgage compliance use case
Yeah,
for tying out some regulatory requirements. Yeah, I worked with it for a few hours on
yeah.
Saturday and was happy with the results. Yeah.
What I've been using it for is to start off by creating 10 complex search paragraphs that circumnavigate a central big idea. And I give it the instruction, say what I'm trying to do is put together some comprehensive review, and I need to have a wide supporting literature around the central idea. So find me at least 10 subdomains, and then give me a detailed prompt of 10 keywords for each of the 10 subdomains. And then I run those 10 through like Notebook LM's deep research, which is a Gemini 3 deep research. And it'll go out and you can select either the web or Google Scholar or a Google Drive. Ultimately, you want to have a couple million documents in your Google Drive. But in the meantime, you just kind of search the web unless you have to have some kind of scholarly treatment. So, or you could run both. So I have it search the web, and typically each complex search comes back with about 30 documents, plus or minus. Now, two or three of them may not be eligible for download. Like I'm helping a kid do a master's thesis on medical evacuation planning and what can we do with AI in order to reduce the travel time from point of injury to definitive treatment. So we're setting that up as a giant reverse supply chain. And there's something I can do with AI at all of these points in the supply chain that might reduce some of that transit time, including some things like do a better job understanding the enemy's capabilities in our attack plan to know where the density of casualties is going to occur so that I can reposition assets there before the fight and not have to try to find them and rush them over there once the surge occurs. So I can
Mhm.
improve planning. I can improve response time so that once I've had my initial array of helicopters and armored ambulances, as I start reading the battlefield, if I see it's starting to diverge from our estimate, I can follow the data instead of fighting the plan. So I can be adaptive during operations. I can put an AI doc in a box so that each forward treatment team has access to world-class triage and diagnosis. I can adjust my medical supplies and blood to respond to the density of injuries. I can put it on the helicopter. I can, all that shit. So since I know I want this thing to gather literature about that, I can say, I want you to give me, that's generally what I'm trying to do, but make sure that you include things like value chain, supply chain, queuing theory, quantitative measures, Monte Carlo, blah, 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 lessons learned from Ukraine, whatever it may be,
Mhm.
and improved planning. And so I will use the uh, Pen 3.0 to help me construct those 10 sets of complex search strings. So I run them in Notebook LM to go out and find what's available in the public domain. I also give those 10 to the kid that's doing the research, and I say, march yourself on over to the Combined Arms Research Library, talk to a library scientist, give them those 10 prompts, and let them search the professional archives to see what it is that may not be available for download through public sourcing. Like when you get the global search back, you might see the references to them, but not have access to download it. So when you notice that there's things coming from professional sources, you can follow up and you can get a list of the things that you couldn't download. And then I have a medical service corps officer who's done this stuff for 25 years, going through his contacts to find out what are the key and essential planning documents. So we got three different sources of search going in to build out the baseline of our document literature review. So right now we got about 250 documents, papers, chapters, books, field manuals. Um, there's a couple master's theses in there, including one I did with a kid 23 years ago. I didn't think it was that long ago, but I remembered it. I thought it was like a couple years ago. So once we have all that, then I can have Notebook LM go through that as a RAG and generate all of the cross connections and themes and issues and all that, and start building out what looks like a summary of the history of this kind of planning, possible inserts, give me the most current sets of planning factors, make recommendations for how AI can improve this, find other supply chains that are similar to this, that are time sensitive, high risk, um, highly consequential, and find ways that I can learn from those kinds of systems what AI could maybe do for us. So the Pen 3 is sort of ideal for three or four different phases in that entire research process. We'll end up using it to write summaries, to write pieces of curriculum, but also to help him find the best set of important research questions that are driven by the data that we actually gathered. We have some ideas about questions we want to ask, but it may very well be that the answers are already out there. We just didn't know it. And so our research is just, oh, find the answer, there it is. So we'll try to find the most important unanswered questions in order to advance the state of knowledge. And then we'll distribute that across the whole college, and we will collaborate with the proponent for medical planning in the Army, which is down at Fort Sam Houston, Texas, and the Surgeon General. So I say all that just to say Pen 3.0 is my general contractor for problem finding, problem framing, and problem solving. Works in a lot of different ways. So um, I find that the combination of that plus Notebook LM as the repository for all those documents that I want to narrow my search to just that content is a very good partnership. Um, so that's my check in and all things bright and beautiful. Mark, how are you doing?
Doing good. Doing good.
Cool.
Just gonna head out to the Netherlands for about 10 days here coming up. So looking forward
Nice.
to
Nice. What's
going
happening
to
over there?
my son is a senior in college and he spent a semester in the Netherlands at Maastricht for
Oh,
he's in finals right now. So
what's he
we're
working on?
he's just finding himself. How about that?
Yeah,
He's a finance major, but he's taking Dutch classes
Yeah.
and uh,
I know the feeling.
yep,
I
yep,
know it well.
exactly. Yep. So we're excited to go. So
Hmm.
Hey,
Sundeep, how are you doing?
doing good, doing well. Chugging along. Um, Everything's good.
Yeah, Bob Rourke has been doing some work with uh, GPT 5.2 and Gemini 3 he's feeding it pages of the daily report
Yeah,
and asking it to figure
yeah,
out important things. Here's
yeah.
here's the biggest idea I have in my head right now. Um, and it starts with the idea of a mixture of regression lines. So the regression line is going to predict the next dot in the series, and that would be the perfect price. And then whatever price you actually get, the difference between that price and the predicted regression line price is the error. And then you can sum the total error of all those dots, and that'll give you some goodness of fit that tells you how good the regression line is at predicting or summarizing all of the data. So then if we put some variance on that and we get something like, imagine a Bollinger Band that used the moving regression line instead of a simple moving average as the spine. And then you say, if it's a 10 period regression line, let's say, and I project that forward, let's say 10 days, I would get a Bollinger Band. We would call it a range fan that would show what the expected value would be if it just followed the regression line, and then some Z1 and Z2 brackets around that. Well, 10 days ago, if I had drawn that range fan and projected it forward, now I wake up 10 days later and I plot today's price inside that range fan, I would have a Z score of today's price compared to the forecast 10 days ago. The degree to which it deviates from that is how strong the move away from the mean was, and suggests what a return to the mean would be for a 10-day forward look. Check or hold. Now imagine I went back 20 days and 30 days and did the same thing and found out where today's price was on the Z score that was predicted from the look back period. It would tell you something like, how extreme is this move according to the forecasts and opinions of those guys back in those days? How eager are they to move back towards the projected line? You could then even draw the last 2 or 3 days regression line slope and say, is that thing heading back towards that projected regression line, or is it moving away from it? And then in the aggregate, 3, 5, 10, 30, 90, 270, you would get something like a composite of emotional postures of all those different look back periods. So that's different than the way we think of a Bollinger Band today, in which today's price looks back 30 days, finds the average, which included today. There's no lag. See what I mean? It incorporates all of the subsequent moves and now gives you a current array about where it is according to the last 30 days. But what it doesn't do is tell you how surprising the resulting 30-day move would have been to the guy 30 days ago. If you're a guy that's looking at 30-day range fan, maybe you're willing to wait 30 full days to see where you are before you decide to do something. Or maybe you've been taking moves all along the way. So what I'm playing around with in my head is what that forward forecast now thinks about today's price action, where it sits, where today's price sits, based on what I was thinking 30 days, 10 days, 90 days ago, to see what this, how much, how much emotion, how much energy is in there to move towards a predicted price. Like, what if all of those look back periods all predicted that today's price was what today's price ended up being? None of those guys are surprised. So there's no latent energy about, oh my goodness, my forecast. Every one of them said, yeah, see, I knew it was going to be here. That's what all my models predicted. It's doing exactly what it's supposed to do. But what if one of those things was really out of whack? Like, what if all of them, except the 10-day, what if the 10-day was at a -2 z-score, but all the other ones were higher? It was like it was a high z-score. You would think, oh, well, this is a buy on dip opportunity. So I'm still feeling my way through this to determine how do I figure out
So can I just
how do I find the symbol that has the greatest amount of surprise based on the move of the look back periods? That's what's in my head right now these days.
so Ken, just to make this understand this better for me, this is the 270 regression line, this is the 90 regression line, and
Yeah,
this is like 10.
yeah,
So, so what do we want to forecast today?
yeah. Let me try to. Okay, so today's price, if I looked at the 270, which is I think that solid green.
The 270 is up here.
Yeah.
This 90,
So
yeah,
I am a long way away from that, uh, from today's 270.
yeah.
But if I had gone back 270 days,
Okay, so
and then I had,
let's go back one.
so let's say 270 days ago, I
Okay.
had at day 271, I take a look at the days 271 to 540. All right. So
Um,
I'm going to look back another 270 days. And it's approximately where the thing started to reverse.
right. So
Right.
this is 150 days. The blue box is
Yeah.
150-day look back. So
Okay.
270s, let's say somewhere here.
Yeah. So here's what I'm going to say. The If I took that middle section, starting from the blue box and to the west, I actually I can actually mark up your chart. I just
Yeah.
remember, easier than me trying to describe it. I have to get this idea out of my head and into the world. Yeah. So this is let's say this is approximately the 270 days, right? And the 270-day moving regression line produces this. That's where we think that thing was going to be. And then if I took this, that's the difference between the current 270 and today's price. So that's some amount of error. But the real problem is this 270 right here.
Hmm.
These guys, if you took that line, that's what the 270, the straight line regression would have been. Those guys would have projected it to be like this. It's going to keep doing what it's doing. And now this price is not really, hey, it's a long distance away from where it should be today, but it's really just a nothing. It's just reverting to the mean like it should be. In fact, this price doesn't become a problem until it goes below the 270 forecasted price from 270 ago. And the idea here is that when you look at all the literature, when guys are looking at trying to predict the forward look, whatever the time period was, the X period look back, they try to calculate some formula that allows them to predict what the plus X price range is going to be plus or minus some standard deviation, right? So it was here, and I'm looking back 270 days, and I think the price should be at 270 days forward, plus or minus some standard deviation. So my range fan, look at this is the expected normal. Now, when I project, so when I'm on this day here and my price is up in here, I'm saying, hey, this unusual move up to here, I expect it to come back to this line. But in fact, what that price did was come up all the way to here. That is really how far out of normal that move is. When you're looking at price on this moving 270, it's right about where you might expect it to be. But you had no reason to believe that it could do that because the straight line regression was this. So this is actually not a sign of panic yet. What the sign of panic would be is if this thing reverted to the mean, I expect that. If it goes below this is where danger occurs. All right.
From the perspective of the 270 guy.
Of the 270. So
Okay.
now I can think, so now my current thought is if I had today's price was here and I go back to and I'm 10 days out, I can go to 10 days ago, take his regression line here and say, maybe it was like, I should say the regression line looked like that. This thing is actually, his expected move is to here. Whereas if we just looked at this, we would say, oh, the last 10 days have been straight ahead. That's the new normal. But 10 days ago, we would have thought normal was here. So its ability to stop the sell off and go here, we would say that's actually a really positive moment, almost an abnormally positive moment to be here instead of to the projected here. And then if I went back 30 days, I'd have to go to day 60 to day minus 31, and maybe that thing predicted here, but I'm here. So there is some look back period. I'm trying to put myself in the mindset of that look back period and say how unusual is today's price given the predictions I would have made 5, 10, 30, 90 days ago to see what the psychology is of those people. So here's what that looks like now. Each day that I march forward, I end up getting 4 new looks. I'm going to call it 3 new looks because I think it's the 10, 30, and 90 gives me something like a constantly updated forecast of how weird is today compared to those look back periods. So I'm still in the early stages of thinking my way through this. But what's important on this is that it actually gives you a different look at interpreting today's price. Because normally we think, hey, the last 30 days brought the price to here, and the price action was like this, and there's my regression line. I expect it to go like this. I'm right at Z plus 0. And going forward, it would take a price greater than Z1 to be my alert. So as I look at the price action, at any time in the last 30 days, did I ever get above the Z1 line that was indicated 30 days ago? Where was the surprises? What were the shocks of price? The moving averages or the moving regression lines are have been making me feel like things are too well. Of course, that's the natural ebb and flow. I'm not sure that's the only way to look at it. I don't know what this is going to tell me yet, as except to try to look underneath the price action to figure out if there's latent surprise or profit preservation, that kind of stuff. I just think that if the regression line 30 days ago was this, and I expected it to be here, but now it's here, that's really that's really a big deal because 30 days ago, my plus or minus one was only going to be like this. This thing is well outside of the envelope. And that tells me I better be thinking about what happened in these 30 days now, the subsequent rollout that made it do this instead of that. If this was all really just straight line price movement, then the regression line would be really tight. And the Bollinger Band mean, or the Bollinger Band window, it would look like Z plus zero. Nothing unusual to see there at all. And then all of a sudden, bam, it made this amazing move. What the number we actually care about is what is the percent gain of the last 30 days compared to all other sets of 30-day gains. That's
Mhm.
actually a simpler way to calculate the magnitude of the move. But what the moving regression line shows you is the path that it followed and what the slope of that. When the slope goes negative, it tells you, hey, it had an amazing 30-day move and the slope is negative. And there you only need about the 3-day and the 10-day slope to tell you what that short term adjust, because the adjustments to that are going to come in 3 days and 10 days. And and then the reversion to the previous mean projected forward will tell you what the real hidden expected price of that thing is going to be. In some ways, the volume weighted average price, the anchored VWAPs, give you some feeling of where the prices were each day, but it doesn't address how surprising was that move. So I'm trying to come up with. I've never heard it said that way or seen it written that way, which makes me want to see if there's any gold in that mine because I think there's a way of finding like really surprising anomalies. I don't say, obviously Rigetti was trading at $20, went to 550 and came back to 50. All the guys who were holding 50 weren't surprised by that at all, I guess, when they knew that the first move. Anyway, so that's the research question that's in my mind, and it comes from thinking about what can we learn by looking at moving averages of different time periods and their slopes. And then what have we been able to learn about replacing simple moving averages with moving regression lines as a better, more more adaptive uh, uh, description of price? And then it has come back to me, if nothing had changed in days 31 to 60, then days 30 to day zero would have been a straight line extension of that same regression line. Where is today's price compared to the 30 days ago straight line projection? And then measure that as a way to estimate the amount of surprise in the move. So I'm still working on how to express that or describe that or illustrate that because I haven't seen that written about or worked on it myself yet. But that thing it's bugging me. I think there's something in that. So anyway,
Okay.
I have to get that out of my head. Uh, Juan Carlos, how are you doing? And are you ready?
I'm doing good. I'm doing good. I am ready. Yes, I will. I missed the start of the meeting because I was head down on Excel.
Yeah,
So,
I'm familiar with the problem.
so I was doing amazing and I didn't know that. And that's a horrible thing. Um,
Yep.
so I finally compiled my
It's a good
statistics.
problem to have.
And
The solution is more fun. Like
yeah,
like I'm not in a hurry to find the solution, because maybe the solution is going to change what you were doing, and maybe I don't know. Anyway, go
It's
ahead.
not gonna work anymore. I don't know.
That's right. Start monkeying around with it and fix it so that
Yeah.
it doesn't work.
Okay. Should I go
Yeah,
or?
yeah. Go
All
ahead.
right. So where is Excel? No, this one. Yeah, 2512. This one. All right, we're in.
Not yet.
So I
Yeah.
accumulated 133 R, and because I had such a small position size, the graph looked nice, but I just didn't know. And now that I'm looking at the R's, things are changing. So my equity curve from that looks something like that. And yeah,
Approved.
it was like a month of trades
Yeah,
since November 1st. I put in what, like 400 trades now, and it was a
yeah.
50-50, 239 ratio, and 232 on my risk reward. Yeah, I'm
Ladies and gentlemen of the jury,
Yeah,
yeah,
what are
I'm
your
blown away.
questions?
those are impressive.
One of the things that changed was that I started adding symbols, the AI symbols
Yeah,
being GGLL, the best one.
yeah.
And
That one's you know, if I were to go to sleep for 30 years and wake up,
hmm,
you'd have to really twist my arm not to pick GGLL.
yeah,
I
no
just
shit.
think everything about Google, uh, they own the knowledge and information warehouse and the inventory system and the ability to find everything and to classify things. Yeah, it takes computing power to do that.
But they have a lot of that. There's
Yeah,
a
they do.
for those of you that listen to podcasts, there's a very interesting podcast called Acquired.
Mhm.
And they go for like 3 to 5 hours. They're very long, but they do a pretty tremendous one on
Yeah,
Google and
spell
basically
the name of it. What is it?
acquired,
Oh,
like as in
acquired. Okay.
to purchase. Yes,
To acquire. Okay. Acquired.
acquired, and they have a I think it's 4.5 hours on Google, and it's all about basically it started off as an AI company 25 years ago and is
Yeah,
now
and nobody
recognized.
knew. Yeah,
It's
and
really impressive. You see the people that go through it and the way they did it. It's a really great podcast. I highly recommend it. I haven't finished it yet, but
yeah.
it's worth your time.
I knew they were good when I read, now this was probably 15 years ago. Of all their computing power, 1/3 of it was used to store the internet. A second third of it was to reorganize the internet to optimize for their search algorithm so that they could get the answer faster by searching through the modified internet that they maintained. So the way they organized it and the proximity of things made it easier to find things like a giant Dewey Decimal System than on the wild, wild west of the internet itself. And the third of their computing power was they didn't know. And they said it was the guy who was writing the article said that's probably where the AI is dreaming and where it's imagining future worlds without humans or something. And I realized, man, to have that much compute and storage, and everybody else is working through the internet unoptimized, and they're going through the internet optimized, can't lose, can't lose. So and then within the release of B2B tools for AI, I mean, they are just releasing actual tools that you can use so fast. It's terrifying how good they are. So that to me is like having control of all information is one thing. Palantir is running a pretty close second, and only because what they own is privileged information. They own all the secret information, so they can blackmail anybody. and they're involved in competitive blackmailing for a price. And they have such a lock on that that you can't even decide not to use them or to go after them because they already have all the secrets and they know how to find it. And it's better to. It's like having Luca Brasi on your side. You want to have that access. NVIDIA is a pretty close third because of the power of the AI chip, but that one is more vulnerable to other smart chip makers who could come up. All it takes is one tech breakthrough to come up with a better chip or a better compute environment. They have an installed base, but there's a certain vulnerability in the same way that the guy who made the best um, uh, automobile engine became vulnerable to the electric motor. You know, the internal combustion engine gets optimized. You got some competitors, but when somebody can give you more power at 1/4 of the weight, whew, and your cost per mile goes way down, suddenly that changes everything. And so you can be very vulnerable to that. But the guy that owns the information and has access to all the secrets don't change. It's having the secret is what gives Palantir the power. And then Google has the superset of all information to run everything. So Palantir, because of governments, and they can own the politicians who will pay them graft and corruption to be on the team, to be on the winning side. So Palantir is a no-brainer
Yeah.
in that sense. Um, so, I mean, if I was going to bet on three, those would be the three. But if I had to bet on one, I'd bet on Google
Yeah.
as it stands today. So, yeah, long story short, yeah, Google and PTIR.
Yeah. Um, these two, the triple Qs and the
Yeah,
Russell 2000 did really well as well.
yeah,
Um, but I noticed that I have to be super careful because it was great last month, but as
yeah,
it started consolidating,
yeah.
the same behavior as before.
Yeah, but now here's where you have to put the multiple uh timelines on this because you could have if you just look at the last 10 days, you have a positive slope on that thing. But the only reason that slope is negative because of the extraordinary first 10 days and the middle 10 days.
Mm.
So the last 10 days are still favorable, but just not favorable like the first two sets of 10. So this would be a signal like, oh, I think I'm broken and now I got to fix everything. No, if you look at it with the multiple, the rolling 10, 20, 30, 90 or something, or 10, 20, 30, 60, 90, you start seeing the different shape of the tidal forces and where you are in the seasonality of these different time frames to know how it'll give you some sense of when am I overheating on a 10 period or 10 trade and when am
Mhm.
I overheating or underperforming on a 30. So I would say that you want to put the 10 and the 30 on there and then 90 for the long term. So use multiples on that one. Like the rolling expectancy per trade is I think is a better, smoother line to see
Mm.
what's happening. And then you want to pay attention to the
Mhm.
slope of those lines.
Yeah. So yeah, that's where I'm at. It's all opening range. I'm starting
Now
to
let
look
me
at
now
the,
we got to start talking about scalability
oh,
and standard risk per trade. You're in a position now where you want to have a standard unit of risk per trade, and then as it continues to be successful, trading a fixed percentage of the portfolio so that as it gets successful, it trades larger positions that it has earned.
mm,
And then, for example, um, if I were going to teach soccer moms to trade, I would give them a simple rule set. I would give them each $5,000 in an account. I'd have them trade futures. When they double the account to 10,000, I would take 5,000 away from them, set it aside. When they take 5,000, double it a second time, I take 5,000 away from them and set it aside. When they double it a third time, they can now start trading a $10,000 account, so two lots. Then if they lose all 10K, then I have 10K in hand on a 5K original investment. And in the process of them doubling it three times, they will have demonstrated that this is a skill and not um, an anomaly, and they wouldn't get the big head. So that's not the That's not optimal F. It's not even a quarter of optimal F, but it's a sustainable model uh, uh, for a dandelion seed or yeah a dandelion seed distribution or scalability algorithm.
Hmm.
In the same way that if you're an oak tree, the smartest thing the oak trees ever did was influence DNA to create squirrels, which are these energetic little mammals that scour up every acorn and then run away and hide them all over the place in dark, rotting logs, and then short-term memory weakness. So they forget where all their little hoards have been stored, and the acorns have the acorn meat to support the initial growth, and then all that rich organic material from the rotting stump to support the next growth. And the squirrels have carried it away from the main tree, so now they get sunlight. So that's how oaks have decided to propagate, is by partnering with squirrels. So that's how you do that. And even when the squirrel eats the nut, the actual seed inside the acorn is not digestible by the squirrel, and he shits out the seeds and his fecal matter, and that's even more uh, uh, nutritious to the growing oak tree seed. So it's a win-win situation for the oak tree. Well played, oak trees. You know, rest in place. You don't have to worry about moving around. All right, what else you got, man?
What is
It
that?
looks pretty good.
Um,
Next week, I want to hear what your plan for scalability is. I've given you a couple ideas.
yes. Um, wow. Yeah, my biggest thing is measuring position size, um, because the slippage still there.
Yeah,
So there's a huge risk in that. And I don't know.
that's why I think the idea of build the account to a certain size, then set it aside and not compound the tension.
Hmm.
Because if you did this 3 months in a row and you could end 3 months from now, you could be trading five times the size that you're trading today. And that acceleration factor might be more than you're willing to tolerate. The going 3 months without any errors would make each one feel nervous, perhaps.
Hmm.
Or maybe you would say, no, this is just math and I'm just driving on. So you got to decide what your inner shadow self can tolerate for a reasonable growth posture. That's not, you're looking for the Goldilocks scalability process here, of how fast to scale on the basis of, I think you got to, I think you always got to bleed off some of the gains to another pot of money that's, your longer term, like maybe BMR or something like that, so that your rainy day fund.
Hmm.
Like even if you said just 10% of the earnings, just automatically donate. I'd say 20%.
Mhm.
20% of your monthly profits I would push aside, and I'd have 10 for charity and 10 for your retirement and 10 for your kids' estate. And then so I would grow it on 70% of gains. I would keep 70% of each monthly gain to grow the size of the standard position size for a system. And I would take off 30%, and I'd say 10% charity, 10% retirement, and then 10% the kids.
Mm.
And then that way you're still growing with the majority of your money, but you have the confidence in knowing, hey, I am addressing my long-term needs, and I cannot be accused of greed. And then that might make it easier to grow the account with its own profits. So give that some thought. I think a week from now you should be able to brief us on what your strategy is, because these numbers sort of demand that as a piece of work.
Yeah. All right. That's
All right,
it.
boss.
Cool.
Ashe, are you ready, sir? Fire when ready,
I
Gridley.
am. All right. Nicely done, Juan Carlos. That looks great.
Thank you.
That feels like the goal. Am I sharing the right screen?
Yes, sir.
The what do you guys see, by the way? Just
Manic
the
depression.
R multiples.
Your graphs.
Yeah, I
Okay.
got you. Got you.
I got two screens up. So okay. So the short of it is, I was using the R10 box up in here,
Yeah.
and then started to work with the Hogard press, but using a smaller Renko bar.
Yeah.
So I had a meeting with Juan Carlos about a week and a half ago, and he's using something like a quarter of the R10. I think at one point I was using 30% of the R10. So to do the testing, I started to use that, and I think I got lucky for a couple of days because I had this big, little, I don't
Yeah.
want to say big, but move up,
Big enough. Yeah.
um, big enough, and then it just it degraded. So it took a lot of trades.
Yeah.
Um, had this big move down, big move up, and then I had the AI analyze it, and it turns out that with TradingView, I knew there was some delay in the fills, and it was looked like it was almost a whole bar,
Ah,
and it is, and with the quarter, with the Arenco bar being so small, TradingView can't keep up printing the boxes fast enough and firing the orders. So I gave the AI the logs from the Python server, and it analyzed the
yeah.
TradingView stuff, and it said, look, TradingView is not designed for being able to trade this fast. You need to basically move over to something like NinjaTrader that's in C. I think, Juan
Yeah.
Carlos, that's kind of what you're uh, programmed in. Um, so that was kind of its analysis. Now it said immediately, like, revert back to the R10,
Yeah.
where you had more stable, um, results. Like
Yeah.
basically the top
Is
part of
that
the
what brought
screen.
it back from 0 back up to 10?
Um, no, it was just luck. Like it just moved directionally enough to
Okay.
recover.
All right.
Um, so I think that was just
Well, the only
just
way we
happened to
would
be
know
luck.
is if you ran it without making the reversion back to the R10, and if it had a difference in scores.
Yeah, yeah. Well, so kind of where I don't know if it's where I'm leaning, but leaning towards the R10, that box, even though
Yeah.
it's late in the automated entries, I could potentially visually watch. I'm going to switch over to TradingView now. So, and I think I have an R10, not this one, like an R10 setup.
Yeah.
Uh, and I'm considering kind of maybe swing trading, or at least sometimes holding overnight risk. Um, each blue line is a
I,
day.
I am really reluctant to support that idea unless you're
Okay.
trading at 1/20th of the size.
Okay.
And only because the size of an R10 box compared to the average gap will it'll
Yeah.
murder you in the wrong direction. There'll be some days you're really happy, but there'll be other days that'll just be the end of life as we know it. All
Yeah.
you got to do is go back
The
200
gap
days.
stat.
Yeah, go back 200 days, find the
Hmm.
average percent gap, the absolute value of the gaps, right? Because you got to do the absolute value to get a sense of the magnitude. If you just go directional, then it forces the gap close to zero. Whereas if you had a bunch of 2% gaps, half the time up and half the time down, that's an entirely different world than an average gap of zero,
Hmm.
if you see what I mean. So let's say you had 200 days, and 100 days it gapped up 2%, and 100
Yep.
days it gapped down 2%. You'd say, well,
Hmm.
on average, there's no gap, so there's no reason to
Yeah.
not carry the full position overnight. But if that's a coin flip, you could get seven in a row against you at a full 2%. And then if you say, what's the size of the R10 box versus 2% of price? Yikes.
Yeah.
So so when you do the gap stat as the measure of overnight risk, you have to use it as the absolute value. The second run you could do is you say,
What value pair?
am I only going to carry it overnight in long positions, or am I willing to carry it overnight based? It was an extreme move, and I think tomorrow continues. Like
Yeah.
and that's a simple, deceptively simple question. So if I decided I was only going to keep in a bull market, I was only going to keep exceptional moves to the upside where the closing price was significantly better than the VWAP price as an indication that there's a lot of people holding this thing overnight in my direction. Then I would be looking at the absolute value of all the gaps, but I would run a second run on just the negative gaps to see what that looks like, the characteristics of that. Like, what is the adverse gap in a given market? Well, in a bull market that I'm holding on the long side, I only want to study the negative gaps. How big are the gaps against the trend of the market? Because that's the
Hmm.
one I got to absorb because I'm
Yeah.
betting on a continuation. So any positive gap is just like free chicken, which
Hmm.
is what I'm holding out for.
Right.
And then if you compared those, you could say, hey, you know what? In a bull market, fucking, what's the expectancy on the gap? And I will tell you that when I look at the S&P's gap stat over time, that
Yeah.
changes every 2 weeks. In 2 weeks, it can go from 75% of all gaps close higher to
Hmm.
20% close higher. And it'll still be a bull market, but the gap statistic um, does not respect bull versus bear. It changes a lot more quickly than that in as little as 10 days. And I believe, and I can't confirm this, but I believe it has something to do with where we are in the 10-day and 30-day range fan. Like at the end
Hmm.
of a really good 10-day run that had big moves and large favorable gaps, the chances of you getting a negative gap that'll ruin you is much greater. So that's kind of counterintuitive to, hey, bull market has been a great run. Why wouldn't it keep going? It keeps going until it doesn't. And then
Hmm.
so the adverse gap, I actually think my spider sense is that the stronger the directional move, the greater the likelihood of an adverse gap tomorrow. Because now and I think it's because guys are getting nervous once they recognize that they have an abnormal gain, and any kind of adverse news is giving them a reason to get out. And then there's some number of guys that said, hey, I hit my 10-day, I'm holding a positive z-score of 2 over the last 10 days. How much more did I think it was to get out? And so for Sandeep, that I am now reminded that if you take a look at the daily report that has the X day holding period, that's actually a pretty good first step towards what I was describing earlier, and that is to, on average, the last 2,000 5 day holding periods was like 1%. Or what, I'm making this up, 1%. And today we're up 2% over the last 5 days. Okay, so now I have an unexpected gain of an extra percent. When that gets above Z1, now I have reasons to want to preserve an abnormal gain. And if it gets above Z2, I really am feeling fortunate. I had no reason to be able to expect that. And that creates a sense of caution for me at a time when the herd is finally saying, finally, we got a 10-day amazing run. It's finally coming true as I fully expected. And that feels like fool's gold to me. That's the stampede on the gold rush or whatever. So anyway, Ashe,
Okay.
before you start
Thinking
projecting
about
over
overnight
into the
holds.
swing trade holding, there's some significant work that you got to do. And then the more symbols that you're doing, the
Yeah.
greater the research project. And I would start with the big fat indexes first, because I believe they are less likely to be gyrated around by an individual news event. So, like one negative comment about Rigetti in a news cycle can cause that thing to gap 20%. And so that
Right.
just obliterates all of the hard work during the day, whereas on the S&P, you got a much more stable approach. So if you're going to take a look at that, study that gap status I described, and I would recommend staying with really liquid indexes. I might start with the Dow, to be honest, uh, as a way to get a more um, stable position. And then
This
you got
was
to
a
think. Yeah, go ahead.
yeah. Oh, I was just going to say this was these are R10 boxes, $2 boxes that
Yeah,
Sam had mentioned. He's like, hey, this is on my radar for the extreme trends, and it just kind of looked like a collapsing dragon. So
yeah, yeah. Jesus.
I took one manual trade, a second one. Now my position size is based on six of these. It's like zero point 0.6 of a range stat.
Yeah,
So I think it made zero point 0.7 on one. I exited here. It kind of felt done after we got below there, all 270. I think I got lucky with this exit versus this one where it would have gotten out mechanically. And then
yeah,
I didn't trade it the
yeah,
rest of the day. But the other mistake that I learned or I caught was over the weekend I was doing a lot of different testing, and then the position sizing for the algorithm was set to $20 instead of $5
yeah.
because I'm noticing this at $5 this wouldn't have shown any trades because the six
It's too
bars
tight.
at
Yeah,
two
too tight.
dollars
Yeah,
it,
yeah,
it would have been too trade. So then I realized at one point I thought I was earlier in the day at 10 a.m. the account was up what I thought was 5 or 6 R, but it was actually just probably 1.5 Rs, but there was a position sizing mistake.
yeah,
So it just goes to I think I'm trying to do a lot in a short period of time, and then I'm making these mistakes. Luckily, they're
yeah,
still small,
yeah.
but I think I need to
Hey,
slow
here's
down more.
just in
Yeah.
order to defeat that
Yep.
strategy of slowing down and doing less, are you doing any math on counting the length or the number of bars in a row between reversals? Counting length of trend?
Not really. No, not yet.
Like
I
I
haven't.
think, like
I've
I
just been
think
trying to. Yeah.
I would try if you can think of a way to do that. I would count 300 uh the last 300 directional trades and calculate the length of the number of boxes before reversal to get a sense of average uh, what the average was, and then the standard deviation of the last 300 trades, and then I would do a short term thing of the last 30 trades to see if it's starting to favor longer rather than shorter length of trend.
Now, would that be just intraday holds though, or
Yeah,
or
yeah.
would
Like on
you?
this one, I would count like the
Okay.
last trade was one, two, three, four boxes, then two
Yeah.
boxes, and then it looks like 10, and then three, and then five. And so I would just start counting those up and say, when this thing reverses, it
Mhm.
seems like it always goes at 7 is the average plus or minus 2.
Mm.
So if it reversed and I got two positions in, that's only 3 bars into the trend, and I got two positions in, I feel like I'm doing good. And
Mhm.
then it gets to 5. Now I'm at Z minus 1. And then it gets to 7. I'm in the average trade, the length of trade. And if
Mhm.
it gets past 9, I have an exceptionally long trend. Where's my exit? You see what I
Mm.
mean? So, if there's a way that you can put a step counter on that to give you a sense of how
Where
long those
the
trends last, like
yeah.
there's some on commodities where that thing will just go. Like if you put Rigetti on there, you'd see that you might get 30, depending on the size of your box. You might get
Yeah,
30.
I happen to have Rigetti here for the R10 box. I traded that today too, but I got out at one
Yeah.
point
How
because
big is
I think
that
I
box there?
noticed the position size.
Probably 20
These
cents.
are 35-cent boxes.
Okay. That's
Um, I
1%,
could,
right? Approximately,
uh,
maybe no, let's say about a 12 or 1.2%.
yeah, it looks like 20, it's a little bit more. No,
One and a half
yeah,
percent. Yeah.
yeah.
Um,
I mean,
yeah.
I like
Now
these
that's it. So
moves,
that's
but they're
so if you
overnight.
went back, and my point would be is if you went back 300 trades, I
Uh-huh.
think you would see that the Rigetti long side trades
Hmm.
are 10 to 15 boxes long in a row,
Sure.
and the short side trades are a little bit shorter. But that's a good. I mean, that chart right there is a good reason why Rigetti is a monstrously good thing. That
Yeah,
when the horse gets the bit and starts running,
yeah, I
and
can run.
get it get aboard. And that's why I think if you have the stats on the length of those trends, it gives you some idea of normal versus abnormal. You know, it's moving out now. It's a Z minus 1, Z0, Z plus 1, and after Z plus 1, hold on tight. You're on a bucking bronco or something like that. Like I would
The
never
10.
add a position after Z plus 1 of length of trend.
Mm.
I want to get my 2 or 3 in on the front end and then just let the horse run. Which is the argument behind keep 70% of the pot,
Yeah.
which gives it plenty of room on these big wins to flex and keep going.
10,
So
I guess
that's
10
enough.
bricks would be, yeah.
Yeah.
Okay.
So that's
Thanks.
yeah. I think like on Rigetti, I want to have everything in by 7 or 8,
Yeah.
and then let it. Then if it runs 20, hey, more better.
Interesting to
So
think
that's
through.
some things to think about there.
Thanks.
Sam will have an indicator on that one by
It,
tomorrow. This date, dude's a coding machine.
he's been good. He's
Yeah,
been great.
yeah. I just
Yeah.
knock on wood, keep going.
Yeah.
Mark, you got
So
anything for us?
Just Sandeep and I are doing some testing on some of the NDX stuff, so just playing around with that.
Yeah, yeah. I think I may have sent you some. Bob Rourke is doing that too. He's using the ChatGPT 5.2 to look at the NDX and to come up with interpreting the different pages of the daily report. But he's recently looking at NDX.
Yeah.
So if you come across it, then you might shoot him a note.
Sorry, I started resharing, but
Yeah.
I heard you talk about that on the call the other day.
Yeah.
And so I worked with, I don't know if it was which version. I don't know if it was my Sage Advisor or the
Yeah.
new one, but I fed it.
Well, actually,
With,
the new one includes my Sage Advisor.
oh, does it?
Yeah,
Okay,
it
good.
it calls my Sage Advisor as its wise uncle.
Okay.
It says like do
Um,
everything we're going to do with my Sage Advisor, but now add the prompt engineering stuff. So a good thing
um,
to do is if you have an AI with a large context window, I would run my Sage Advisor first just to be sure, and then I would run
okay.
Pen 3.0 for the
Pen
but
three.
and
Okay.
it'll keep both of those in memory. They're pretty efficient in that sense, and it'll give you
So it took,
insights from both of them.
okay, good to know. I'll keep that in mind. But I fed it a week's worth of reports, one weekend report, 5 days on like one of the on the bear move that we had
Yeah,
recently, or the down move, and then another one for the up move,
yeah,
and iterated a couple times. And it was it kind of broke down. Okay, market classification. If it's bull, do this. If it's
yeah.
bear, do this. And then I asked it for basically come up with six symbols. And what was interesting was it's looking for either, well, it's looking for the bias on the
I think it
graphs.
prioritizes continuing momentum as opposed to reversion to the
Yeah,
mean. That's what I've seen
yep,
in with Bob's rules.
Yep.
yep.
That's what
And
I'm seeing
here,
too.
yeah,
It's
And what I think it I want it to find those like the 10-day NDX extremes. I want it to trigger that as a dual direction, as a compound critical state, as opposed to predicting, oh, this is a short candidate. No, it should be finding those as compound critical states, and I think
wow,
uh, which is reassuring to me that if people are not savvy and just kind of blindly follow AI advice, then they're always going to be momentum players and never sharp reversal players. So I think they miss compound critical states and will always be surprised by the first day of reversal, which can be the biggest move. That's been my uh, observation, not scientifically tested yet, but I think that's what it seems
yeah.
to be so far.
So it came up with these
Yeah,
three gates for filtering. I was looking at this NDX velocity, the 10
yeah,
minus the 30, and
I
then,
yeah.
some sort of
I
range
really want you
compression
looking at
dogs.
the 5 day volatility, the sniper's 5 day range Z score. So
Okay.
I would go back um, the last 146 5 day period. That's a 150-day look back and
Okay.
compute. So day minus 150 to day minus 146. 5 day high minus 5 day low divided by closing price of that day 146. That's a percentage. Okay. So the 5 day high 150 days ago was 100. The low was 90. So that's 10. And the closing price of that day was 90. So it's a, whatever the fuck that is, 11%. That 5 day range was 11%. And then march it forward just one day. So now it's 149 to 145. So as you march that forward, 150 days will give you 146 5 day periods. Find the average of those
Right.
and then standard deviation and then plus or minus. Then just take the Z score of those. Now, Today, when price closed, it created a new 5-day range percentage. When that thing is less than -1, then we have an abnormal 5-day range, meaning it's a compression. When it's compressed abnormally for the last 5 days, I just guarantee you that's a sideways quiet channel waiting to explode. And you bracket that and follow the breakout. Now, if that 5-day range compression also occurs at an extreme NDX rating, either near the 10-day high or near the 10-day low or 30-day high and low, all you need is one of those two things to be extreme. You would love for it to be double extreme.
Mm-hmm.
Like I would love to see it close, have a massively good 30-day move, pull back near the 10-day low, stay there in a sideways tightest little channel at the 10-day low, but still within the upper band of the 30-day high. That's a breakout just waiting to go for Kata 2 that'll explode. It's either going to,
Mm-hmm.
if it was 5 days in a row, hardly moving, you would say it's just about, if this thing is going to continue, it better get going. It had 5 days for guys to buy the dip, but they're not buying the dip. Is this one of those 30-day extreme moves that I better be protecting? If
Mm-hmm.
so, then that also means that the volatility surprise to the downside could be big. Failure to follow through for 5 days after a great 30-day move, that's a compound critical state. If it does follow through, then everybody says, oh, it's continuing, and they will pile on that thing as a second and third mouse because they're looking at the steep 30-day gain. And they were holding their breath. They didn't want to be the first guy to buy the break. They were waiting for, okay, 5-day consolidation in a very narrow range. And now it has started to break out from that. Your first leg is up to the 30-day high. And then when it breaks above the 30-day high, it's free and clear. That's your second leg and beyond. That's the upside case. Easy to see. The breakdown below a new 10-day low, though, that is now, I better preserve all the gains from this outrageous 30-day gain, which hasn't gone anywhere for 5 days. That's a profit preservation. That's an urge to sell.
Mm-hmm.
And then that is going to create reversion to the mean momentum back to the 30-day simple moving average or the 30-day anchored VWAP. So now what I have is my favorite trade, -1. It's the second favorite trade, is the massive 30-day gain, overbought 30 days, oversold 10 days, and 5-day compressed range. Win. The only better trade than that is 30-day sell off, 10-day recovery, 5 days of no more follow through starting to fail. That's a Kata 2 followed by a collapsing dragon. That's number one of all time. That's the kind of shit that you see on Rigetti after it explodes and starts failing from 550 all the way back to 50. Because you get dead cat bounces. Now there's nobody left. Nobody believes in it. It starts to stall and fail. Then all the guys who made the money on the 10-day bump say, shit, done. I got my bird in the hand. And then the bottom falls out of it. And if it makes a new swing low, it really crashes. And that thing is massively good on the downside. That's why I like looking at 150-day look back periods, because 150 days ago, Rigetti was up around 500, but it's lost 95% of its value since then. And that's been a series of just cascading Kata 2s and CDs all the way down. The little bounces are tradable intraday, but I would never hold that thing overnight. Not never, not ever. So there's some ideas in there for computing the that's not in the daily report. That's information and knowledge and a strategy that's reserved for the coaching team. The sniper setups. That's some good stuff right there. That's good mojo.
Mhm.
More to follow on that later.
All
Okay,
right.
now Sandeep, what you got?
So I have been working on automated trade analysis,
Yeah.
which is to take the exports of TC2000,
Yeah.
the trade logs, and automatically analyze them. So I've got it to where I had to kind of reconstruct the trades, figure out scaling, all of that. So there was a lot of heavy lifting, but that's done. I can join my trade with the signals for the day, so I can look at it and it can automatically tell me you entered long when you should have gone short on a cartouche. All that is good. The
Yep.
part that I'm missing, and I want maybe some ideas on, is how to do a R capture. And the problem is the way I trade. So if I enter a position, it could be a multi-size position, even though I have like a $400 R as my fixed target, but I don't usually enter just $400 R. So I could be entering two positions
Yeah.
at the start. But I have no way of tracking that after the fact because
Yeah.
the report only says, you entered a position. So I was wondering if there are any thoughts on
Yeah. Are you
how
doing this for intraday or for swing?
intraday and swing, but primarily
Yeah.
intraday.
What the analysis that I do for the swing trade has to do with when to hold overnight, and it's the um, trade quality index. And yeah, I think it can be done intraday, but I would actually just do what I suggested with O'Shea with counting the length of boxes to get the size of potential moves.
But
Uh,
no, so sorry, my question was I want to automatically compute R capture of my trade.
yeah,
I can compute the
yeah,
profits, right?
yeah.
Equity curve I can.
Well, yeah, you
I
just
can,
got what you got to say. You have to enter whatever your entry, whatever your the there is a price that is the signal that your trade hypothesis has failed, and that's 1R. So it's open minus. You need to have the open, and you need to have the price of the 1R loss.
okay, can I show you something? Just
Sure.
so hopefully you are seeing. Oh yeah, okay. So here is a trade log. Okay.
Yeah.
So entry, symbol, buy, price, quantity. Okay.
Yep.
Exit time, sell,
Yeah.
and the P&L.
Yeah.
And
Yeah.
this
You need
was,
one more column. You need one more column that says the 1R loss price.
but how do I calculate that automatically? Meaning, this is I can I can
At the time of the price, you have to know what the 1R loss is so that you can compare that to the potential gain, so you know what the framed reward to risk is.
so I could do like an R10. So, but the problem is, so
So
I
here's
use
what you do. Here's what you can do.
yeah
I would standardize this against the frog box.
okay
And then you just say, look, I'm gonna, and then all day, every trade is going to be some multiple of a frog box capture,
hmm
and then whatever you decide for your position sizing or what my actual exit would be on it doesn't lock you into using the frog box as your 1R,
right.
but in terms of just as a measuring stick, you need a constant unit of measurement for each day. Okay.
Yeah, so I'm good with the frog box. So I could say one frog box, how many that becomes my risk. But the position size you're saying is because I could have $100 unit
Yeah,
for that frog box.
you don't care about position size at all on this analysis.
Okay.
For our capture, all
Okay.
you're looking to see is how many units of gain did I make against the frog box metric? How many
Okay.
frog meters
Okay.
did I get on this jump?
Okay.
From that, you could actually then compute the expectancy of that system um, on the basis of the actual trades that you make.
Okay.
Let's say that you were using an R10 box
Mm-hmm.
as your actual exit.
Yeah.
Um, that R10 box is going to be the same. Hey, but here's the real problem: is that sometimes I'm using the R10 for my actual exit. Sometimes I'm using the R5. On an intraday trade, you're never going to be larger than a frog box.
Right.
So just use the frog box as the metric. And then when you look at that, you say, hey, on average, a frog box is about 3 R10s,
Yeah.
plus or minus.
Yeah.
So if you were using the R10 for position size and you got a 3R, that'd be you gained a frog box.
Mm-hmm.
And then so you got a 1.0 on that one. And then on a trade where you lost an R10, it'd be minus 0.3.
Yeah.
And the ratio between your average between your wins and losses would be the same.
Okay.
Now, let me describe. I have a slide deck somewhere. It's getting a little bit late, but here's what you do on swing trades. Let me share my screen real quick
Yeah.
if I may. File, new image, create. There's, I think, somewhere in one of the videos, there's a video lesson on this as well. The trade index analyzer. So I got a little spreadsheet that calculates this for find my um, dropped it somewhere. Damn it. Ah, dummy. Oh, there it is. Tried to find a black pen on my black desktop with no lights. Yeah. All right, so let me. This is a really good idea for swing trading, and I think it may be all right for intraday, but it's better for swing. Let's see, share screen. This revolutionized my swing trading, and it made me an intraday trader, leveraging swing trades that failed. All right, let me know when you can see that.
Yep, we can.
Okay. So there was some setup day over here. Let's say it was 5 days down. So I said, okay, now I got a signal, and I'm going to go long. Come on, boys. So I'm going to go long here, and I'm going to go short, or I'm going to exit like right here. Okay. So I get some kind of move. I got to draw with a mouse. So I get an open here. Next day, it gets me long here. And the trade does something like this. And I keep 70%, so I get out that day. So I was in that trade 1, 2, 3, 4, 5. Turns out I was in that trade 6 days. Okay. So what I'm going to do is go out 2T, and in the 2T time frame, I'm going to find the highest high and set that equal to 100. And then I'm going to find the lowest low. Hey, maybe that thing went like this. This would be awesome. So that was the path that it took. So I'm going to set that equal to 0. And now I've got 100 basic units in there. So now what I can say is on that scale, my entry was about a 40, plus or minus. My exit was about a 60. My best 1T time frame was 75. The best price in the 2T was 100. My worst thing was a 0, and that was in the 2T. So the variable, sometimes my trades are only 3 days long, and then my 2T period is 3. And the idea here is that however long I held the trade, if I just double the length of time, then whatever the conditions were on the first T time frame are probably still in play for the 2T. So I'm in the neighborhood. So I get some kind of, I get 100 trades, trade 1 through 100. I want to know what my entry index was. I want to know what my exit index was. And then I want to know where was the 100? Was it over here while I was in the trade, or did it happen after my trade? And then where was the 0? Did that happen in this part of the trade? So I ended up getting out here, but that thing ended up going all the way down here. Then it turns out, oh joy, my stop loss protected me against the disastrous exit. In this case, my stop would have been at like 30. And so what I actually ended up having was, I didn't know it at the time, but there was 10 index points. Then I exited, but that exit protected me against 3 times greater loss. That's good information to know. Here's what I discovered when I looked at 3 years of the 5DD. My average entry was at 54. My average exit was at 60. And I had a positive expectancy system that was better than buy and hold. And this is what I learned. Most of the hundreds occurred in the 2T time frame. My average maximum favorable excursion was about 65 on the 1T. So what that meant was I was gaining 6 points on average, or I'm sorry, 6 points on average, but I was making 11 points to the local high, and then I was given back 5 points to net 6. And I realized I was given back too much money. I was only capturing about 55% of the move that was made while I was in the trade. And I realized what I needed to do was move that up to keep 70% instead of 55%, which was a net increase of 15%, which was a quarter or a third of what I was keeping. So that was actually a significant increase. That was about a 30% improvement on the trades that I had. But the second thing that I noticed was that when I was getting out at 60, in the next T time frame, there were still 40 index points available on average to the upside, of which I had only just captured 6 or seen 11. So there were big moves in follow through on the upside. But there were huge moves on the downside. There were 60 index points available in the 2T time frame that I never even saw because I was only framing trades where I had a structured pattern to alert me. And so what I learned was that the Kata 2 re-entry might be a better trade than the first trade. And that sometimes this move, when it failed, was a stop and reverse in order to get to the 100, which was happening, or to get down to 0 right away, especially in bear markets. But that after it had made a measured move, if the Kata 2 failed, I should be short on an intraday basis and keep playing that until it keeps going. And then way back over here, if I never even got the entry, but it just failed right away, I should always be short. And that was true for triple screen, 5DD, especially washout patterns. And all I needed to have on this, I could do this in XLQ. I just needed the entry date and price, exit date and price, the 1R price, calc the number of days so I knew what the T time frame was, double that to the 2T, and then find highest high of the T time frame and of the 2T time frame, and then the lowest low of the T and the 2T time frames. And I could compute all of this and come up with standard index numbers that would give me an appreciation of how much of the move that was there was I capturing, how good was my exit as in terms of protecting me against downside losses, and when it hit the stop loss for a 1R, was there a reason that I should be interested in the downside? And what that taught me was I needed to frame the trades in both directions and restrict myself to compound critical states, which offered me reasonably large moves in both directions against a small, manageable risk, and then to be ready for continuation patterns until infinity. So on that basis, I started to, because I only wanted to take those short side trades intraday, studying the swing trades persuaded me 25 years ago to become an intraday trader informed by the swing trade. Keep swing trading, but use that as information to find targets that were ready to either follow through and add momentum or to reverse momentum. And then what was the magnitude of the move out to 2 or 3 sets of targets. And that's essentially what I do is I find the immediate target, the second and third targets in both directions. So if there is 3 legs of follow through, then I have an appreciation for what those look like. And I am typically now just using those as inflection points in the RL10 or standard support and resistance. So that's how you do that. I have a much better set of slides that shows it without all this chicken scratch, but I'm too tired to find it. I know I have to just search for trade quality index. It's in the swing trade advanced course. It's a supplemental briefing that goes way back. It's some of the best. It was the best idea I had 25 years ago and it converted me to an intraday trader. I wanted to be a swing trader because I was active. I was just coming to the end of my active duty military, and I didn't have a lot of time to be monkeying around with intraday trades. But I was becoming a civilian military school instructor, and now I could structure my days to trade on hourly bars at certain times of the day. And then that became a much lower risk way to trade with the information being generated by mechanical swing systems. And then from that, the frog box became the idea for the standard intraday movement away from the entry or away from the open. And that's why I would say if you use the frog box as your standard unit of measure, then as long as you're translating everything into the frog box, that's a daily updated number. And you can create that easily. You don't have to use that as a position sizing or an exit signal, but it gives you a constant
Yeah.
unit of length unique to each day. And we calculate that some bitch anyway. It's a good unit of measure for that reason.
No,
Make
this is
sense?
great. This is great. Lots of ideas.
Yeah. That's a great big old idea. I'm going to go find that video and the slide deck and I'll shoot it to you. I mean, it might even be in the coaching. If it's not in the coaching list of additional lessons, I'll put it there. But I will send you the link to it. I know it's in the advanced swing trade course. Because I have run that for other people that just had all I needed from them was the number of the trade, the symbol, entry date and price, exit date and price, and I was computing um, just the size of the index was just like they were using like one ATR, two ATRs as standard. But all I really needed to see was what was the index value
Mm-hmm.
of the average trade, and each trade had its own particular characteristics. And I was astonished to see. I had been teaching the mechanical swing trade system for 5 years, and it was positive expectancy. And it wasn't until I did that math. And I remember to this day teaching that weekend workshop, coming back totally exhausted. And on the plane ride home, I was in a dream state thinking about that as an index because Chuck LeBeau had been there and was talking about things. And he was doing like visual inspection of the 2T time frame. He said, if you want to just see what else was available, don't run away from your trade when you exit. See what else was happening in the neighborhood. And when I got home, I jumped in the hot tub and was staring at the dim. It was 2 o'clock in the morning and I was exhausted. And I had that idea and built the spreadsheet that night. I still have the spreadsheet. I'll share it with you too, but that's a really good idea for swing trading. I mean, really good. You could even apply that to BMR. You'd be pretty happy if you did. Only what I would do with the BMR is I would just project 30 days after, even if I held the thing for 7 months and then exited, I would look at the next 30 days. Like I'm not going to go out another whole 7 months. I would go out just 30 days because that's the next decision time frame. But that would give you updated insights to BMR about is there one more little squeeze? Could I re-enter and get a tactical swing trade out of a good BMR that had just exited? Or is there a short side trade on the BMR? Because the BMR has a 10% trailing stop or 5% if you've gained 15 to tighten it up. Well, after it hits that exit, is there a continuation? And there almost always is as a short-term reversion to the mean trade. That's a big idea also. And it doesn't take much time on the weekend to set that up and look at what the opportunities are. In fact, you could make a living off of running BMR every day and finding the exceptional gainers that were starting to collapse, and then use some short side intraday or short swing on those. And something that had just was at the bottom of the BMR stack and is starting to recover, that'll give you some short-term washout type patterns that a short-term trader could exploit. Just with information that's available from the BMR methodology. So what we're doing is we're talking about the use of standard mechanical trading systems that provide information content for shorter term systems. So that should wet your whistle. Okay. All right, that's everything I got. Get the daily posted and published. And I just finished processing Thursday nights from the other coach, so I'll be uploading that in a half a second, and then yours later tonight. So, ciao for now. Take good care.
Thanks.
Okay.
Good night.